Long-term Treasury bonds just flashed a warning for the stock market. TLT, the fund that tracks long-term government debt, is down 1.42% over the last 30 days. And because bond prices move opposite to yields, that drop is telling us interest rates are climbing. Here is why that matters. The rally that pushed stocks into record territory was built on strong earnings growth over the past few quarters. Now the bond market is pushing back hard, and that foundation is being tested. The bond market is pushing back. This is not an abstract concern. TLT's decline is a direct, measurable signal. Bond prices and yields move in opposite directions, so when the long bond fund slides, long-term interest rates are rising, and that puts pressure on equity valuations across the board. When yields climb, two things happen at once. Borrowing costs rise for companies and bonds themselves become real competition for stocks because investors can suddenly get paid more to own fixed income instead. The math works until it breaks. Stocks can usually absorb gradually rising rates when earnings growth is strong enough, but there can be a threshold where that math breaks down. Sharp moves higher in yields can trigger rapid repricing across the major indices. Income investors feel this first. When government bonds offer higher payouts, the appeal of high dividend stocks can diminish. If a portfolio is built to generate monthly income, this rising rate environment demands a fresh look at whether those dividend names still offer a compelling spread over risk-free alternatives. So what is the desk watching? Selectivity. The trader's agency team is focusing on companies with the pricing power and the balance sheet strength to weather higher rates. In this environment, selectivity matters more than ever. So can earnings growth outrun the bond market? Three pressures define the setup. Rally risk. Rising yields are a direct threat to the current advance. TLT weakness. The recent decline signals rates may still have room to climb. And earnings dependency. This market is relying on continued strong earnings to justify valuations in record territory. So what flips the story? Watch three things. Further declines in TLT would say rates are still climbing. Any deceleration in earnings growth while yields rise could create a particularly difficult environment for stocks. And Treasury yield levels themselves will show whether this rally gets temporarily derailed. TLT is the gauge. Minus 1.42% is the signal. And if you want to trade moves like this with a real plan, click the link in the description, scan the QR code on your screen, or go to startwiththa.com to learn more. That is startwiththa.com from the Traders Agency team. That's the briefing from the Traders Agency team. Subscribe for daily market analysis. This is education, not financial advice. Trade smart.